Welcome back, everyone, to the fifth and final module for the beginner course. This module is arguably the most important one of all, and hence why we've saved it for last. Now that we've gone over the basic foundations behind the markets we will be trading, it's important for us to lay the groundwork for a successful trading future. This all starts and ends with risk management, so let's jump right in. Risk management is the single most important skill to becoming a long-term profitable trader. While technical analysis will help you make money, risk management will help you keep it. If traders don't manage their risk properly, they won't last very long in the trading game. I liken this to having chips at a poker table. You can be the best poker player in the world, but all it takes is one wrong gamble to lose it all. Now, we don't want to gamble when it comes to trading. Yes, in essence, that may be what the outside world thinks of traders, degenerate gamblers. But the truth, however, is a little more nuanced. Traders are statistical risk takers, speculators who bet on high probability setups to earn them more returns than their overall risks. We'll get to risk and reward in just a bit. For now, I want to talk about the position sizing formula. Now, you may want to pause the video and read it over and over until it is ingrained in your mind. Your position size on any single trade is based on your total portfolio, also known as equity in dollar amounts, multiplied by your risk percentage, and lastly, divided by your stop loss percentage. This is the most basic building block of risk management. Now, before we dive into an example, I want to reinforce this last statement. The preservation of capital comes before profitability. Full stop. Remember our poker example? Well, a player who manages their risk properly will always have enough chips to play another hand. That's our goal. Stay in the game and keep enough chips so we can live to trade another day. Now with that out of the way, let's get into a theoretical example. Here we have a theoretical portfolio of $10,000. Now let's assume we already defined the parameters of our trade, and we decided that this setup was worth risking 1% of our capital on. Well, 1% of our total portfolio is a nominal amount of $100. Let's also assume that our stop loss is based on some sort of technical support and is equal to 5% away from our entry. Now don't worry if you're confused on any of the terminology, as we will be going over it throughout the remainder of this module, as well as in the next intermediate course. Now back to the example at hand. With a $10,000 portfolio, 1% risk, and a 5% stop loss, our total position size for the given trade should be equal to 2,000 units, or contracts. Contracts are the tradable units derivatives exchanges use to initiate long or short positions. Now let's break it down a step further and see what that example really means and how it relates to risk management. If we risk 1% of our capital on that trade, it means we can theoretically take 100 trades before we go bankrupt. Remember that this relates back to our poker example. If we lose 1% of our portfolio on any given hand, that means we can still play 99 more hands. That's 99 more chances to make money. Now on the flip side, what if we had gone all in on that trade? Well, if it had gone against us, we'd be broke and leaving the table with a heavy heart, knowing we put our entire portfolio on the line on one single opportunity. Are you starting to see the common theme here? As traders, we are not fortune tellers with crystal balls. We don't know what the outcome will be on any one of our trades. What we do know beforehand is exactly how much we can and should risk on any single trade. Now, as a general rule of thumb, we will want to keep our risk per trade between 1 to 5%. As you get more comfortable with certain trades and setups, you will learn to craft a system around your best performing trades, and therein risk more on those specific setups. We will get to journaling and stats tracking in the second half of this module. For now, let's move on to the relationship between risk and returns. Now, risk is defined by the maximum amount of money you are willing to lose if a trade goes against you, while return is defined by the expected amount of money you can earn if a trade goes in your favor. Now, at first, it will make sense for most of you to think in dollar terms. However, with experience, you'll learn that the dollar amount is actually irrelevant. It all comes down to percentages. This will help us nurture a true trader's mindset. If we want to become full-time traders and plan on making hundreds of thousands or even millions of dollars, percentages are the only way we'll be able to stay level-headed. Now let's move on to the last bullet, triple R and R multiple. Triple R is essentially our expectations for any given trade. This is the ratio we will analyze heavily and determine if the setup is worth taking in the first place. Your expected risk to reward ratio. Now, after you've actually closed the trade, the final outcome is known as the R multiple. Now let's jump into an example so you can see exactly what I mean. Here we have a theoretical long trade on the Bitcoin dollar pair. Now our entry would be at $10,000. Our stop loss would be at $9,500, and our expected take profit target would be $11,000. Based on this, our risk reward ratio would be equal to 2. This essentially means we are risking 1 unit for a potential return of 2 units. In dollar terms, this equates to a risk of $500 to potentially earning $1,000. Now let's take it a step further and see what happens as this trade plays out. Now, for a number of varying reasons, we may be sitting in this trade and see 2 indecision candles or dojis like the ones above. This may cause us to wonder if a reversal may come before our intended target is reached. In this case, we may think better safe than sorry, so we close the trade at $10,750. Now, on the post-mortem analysis of this trade, we will refer to the actual take profit level instead of the expected. This means that even though we risk $500, we only earned $750, which would be equal to an R multiple of 1.5. This means we earned 1.5 units of risk instead of the intended or expected 2 units. Now this will become much more relevant in the next section as we relate our win rate to our R multiple. For now, let's backtrack and circle back to our initial position sizing example. Remember how we had a theoretical portfolio of $10,000? Well, if we had used our entire portfolio on that last trade, we would have earned $750, or a return of 7.5%. But what if the trade had gone against us and we had gotten stopped out? In that case, we would have lost $500 for a loss of 5% of our portfolio. Now, had we stuck to our original game plan and stuck with the initial 1% risk we agreed on, we would have only lost $100. Do you see why? If we implemented the position sizing formula correctly, we would have only been trading 2,000 contracts as opposed to 10,000. In that scenario, a 5% stop loss on 2,000 contracts equates to only $100 worth of risk. I hope you can see just how important risk management is when it comes to trading. Now let's circle back and do a quick recap before we move on to the next section. Risk management is the only defense against bankruptcy. Trading without risk management is essentially gambling. Ultimately, Those traders who have strong risk management skills will eventually outlast and surpass traders who are better analysts. It's important to remember that position sizing will directly affect our profit and loss statement as it relates to our portfolio or equity curve. And lastly, traders are not fortune tellers. We never know what the outcome will be on any given trade. That's why it's of paramount importance that we always identify the risk of our trades, since returns are never guaranteed. I'll repeat that. Returns are never guaranteed. By defining our risk, we are one step closer to creating a profitable trading system. Now in the next section, we'll be bringing lots of math into the equation. Thanks for watching, and I'll see you soon. Welcome back to Starting to Trade. Today, we'll be incorporating plenty of math into our conceptual framework of risk management. This will help us understand quite bluntly how traders cannot rely on luck in the long term. Trading needs a scientific and systematic approach in order for us to be consistently profitable. That's the goal, isn't it? To make money consistently, not just once or twice. Well then, let's dive right in. Let's first talk about the relationship between win rate and R multiple. As traders, our profitability is a direct function of our historical win rate and our average R multiple. Remember from the last section that this is the actual outcome of the trade, not the expected returns we'd like to see. In order for a trader to be profitable long term, he or she will need to fall into one of the three categories. This trader's setups either have a high win rate but a lower R multiple, a lower win rate but a high R multiple, or in the best case scenario, a high win rate and a high R multiple. Traders who are not profitable, on the other hand, will likely fall into the low win rate and low R multiple setups. Now let's take a look at the math behind profitability. Here we have the break-even formula. This formula tells us what win rate is required in order for us to break even, based on our average R multiple. Now our R multiple can only be derived from a thorough look at our historical trading data. This will all make a lot more sense as we get into journaling towards the ends of the lesson. For now, let's take a peek at the math. With an R multiple of 1, meaning that we stand to earn the same amount as our initial risk, we need a win rate of at least 50% in order to break even. This is similar to flipping a coin heads or tails. If we risk $1 and stand to earn $1 if we win, we'll need to make the right guess at least 50% of the time. Now what happens if our R multiple is only 0.5? That means we only earn half a unit for the full unit of risk we take. Well, we see now that we have to win 67% of the time, or more than 2/3, in order to break even. Now let's take a look at how this changes when our R multiple is 2. Meaning we earn 2 units for every unit of risk that we take. In this scenario, the required win rate is only 33%. That means we only need to be right 1/3 of the time in order to break even. Are you starting to see the trend here? As we return larger multiples on our risk, the required win rate to break even diminishes quickly. This is what most traders strive for. We look for asymmetric trade setups, where we stand to earn multiples greater than 1 on every trade we take. By taking these kinds of setups, we increase the odds of breaking even and eventually becoming profitable. Now, it goes without saying that just because we take asymmetric setups, that doesn't necessarily mean that the probability of them working out in our favor correlates. In fact, newer traders usually have no idea what the win rate on any one of their trades are. Now this is where the power of journaling will become even more apparent as we move forward. For now, let's shift gears and move on to some more blunt realities. Let's talk about drawdowns. Now, no trader likes to talk about drawdowns, but if we ignore this reality, we stand to lose a lot more than our ego over the long term. As we can see here, a drawdown of 5% requires us to earn back 5.3% in order to recover. A 20% drawdown actually requires 25% return in order to get back to break even. You see what I'm getting at? This is why risk management is so crucial when it comes to trading. If we start risking larger percentages of our portfolio, it will become harder and harder to recover if a trade goes against us. This is why sizing our trades effectively is of paramount importance. With that said, let's move on and talk about yet another painful truth in trading. Let's talk about statistics for a second. This table here gives you a great idea of what you can expect as a trader. What's that? Did you think you can run from math and statistics? Well, my friend, it's time to make you blatantly aware of what can happen as you trade. Depending on your win rate, here are the statistical chances that you will eventually go on a losing streak. With a win rate of 50%, there is a 3% chance that you will go on a 5-trade losing streak. That means that at any point in time, there's a 3% chance that you will lose the next 5 trades in a row. Yes, even if you're on a hot streak and compounding your portfolio like crazy, there is a non-zero chance that you will go on a losing streak. You can see just how much that percentage increases the lower your win rate. Now, with this in mind, how do you think traders survive and make careers out of trading with these very real odds stacked against them? It comes down to one thing: your trading system. In the more advanced course, we will talk at length about how to create and define one system. For now, however, all you have to remember is that with these statistical probabilities, traders have to craft and rely on their system in order to avoid financial ruin when they eventually go on a losing streak. And make no mistake, losing streaks are inevitable. Let's move on and talk a little bit more about drawdown and how we relate that to our capital allocation. Here we see exactly what happens depending on how much static risk we take per trade setup. If you're starting to notice anything, it's the need to limit your drawdown as much as possible. You'll remember from the last section that returns are never guaranteed. We can only predefine our risk. With that said, we'll notice the obvious. The more we risk, the larger the drawdown becomes over time. Well, it's not all doom and gloom. Let's switch gears for a sec and talk about the bright side of trading. Let's talk about compounding. The power of compounding cannot be understated. It's the allure that draws everyone to the idea of becoming a full-time trader. Compounding is quite literally how traders make a living. We'll notice what happens when we use our theoretical portfolio of $10,000 and apply some trading statistics. With an average win rate of 55%, an average R multiple of 2, and a static risk of 2%. Look what we have here. That looks like a profitable system I can get behind. How about you? Now let's pause for a minute and do a quick recap before we move on to the next lesson. As mentioned earlier, we'll want to start thinking in terms of percentages, not notional amounts. Since we cannot run from math, we might as well start embracing it. Let's not forget losing streaks are inevitable. We will need to trust our system to get us through periods of drawdown. Now, understanding the relationship between win rate and our average R multiple will help us craft profitable trading systems. And lastly, compounding is absolutely no joke. And when we are finally able to craft a profitable trading system, we may feel like we have stumbled upon the holy grail of trading. Let's make no mistake, however, that the holy grail does not exist. I'll repeat that. The holy grail of trading does not exist. However, we can adopt certain frameworks that allow us to utilize the odds in our favor and forge solid trading systems. In the next part, we'll be taking a look at 2 of these concepts and how we can implement them in our trading strategy. Thanks for watching, and I'll see you soon. Welcome back to Starting to Trade. Today, we're going to be taking a look at something known as the Kelly Criterion and how we can potentially use it to help us create a trading system. Let's dive right in. The Kelly criterion is a scientific approach to betting, one that aims to tell us exactly how much of our bankroll or portfolio we should risk in order to maximize our returns over the long run. Now, there are a handful of interpretations for implementing the Kelly criterion in trading, sports betting, and other forms of gambling. However, for the purpose of this lesson, I am going to run us through a few examples and the way I utilized it to create my own profitable trading system. The formula is as follows. K equals 2P minus 1, where K is equal to the percentage of our portfolio we should risk, and where P is equal to the probability of winning. It's important to note that if the output is a negative number, it simply means we should not be taking the bet. So in the example below, let's assume that we're flipping a loaded coin, one that is likely to land on heads 60% of the time. If the payout on our bet is equal to the amount that we risk, that is an R multiple of 1. We will want to calculate the ideal percentage to bet every single time. If we plug and play the numbers, we come up with a K equal to 0.2, or 20% of our portfolio. Now this is the simplest example of the Kelly criterion. As traders, we know our R multiples may vary depending on the trade setup. So how do we account for that? Well, here is a modified version of the Kelly criterion that allows us to input dynamic odds. That is, in our case, varying R multiples, where K is equal to the percentage of our portfolio, essentially the risk per trade, where B is equal to the net odds, essentially the R multiple, where P is equal to the probability of winning, or in other words, our win rate, and lastly, where Q is equal to the probability of losing, otherwise just our win rate minus 1. Now that we have the framework, let's take a look at a more specific trading example. Here we have our trade setup data. The average R multiple on this particular setup is 3 to 1. Again, that means that we stand to earn 3 units for every unit of risk that we take. And let's say we have calculated our win rate on this particular setup to be 55%. Utilizing the modified Kelly criterion, we come up with a calculated risk of 40%. That means the formula is telling us that we should always risk 40% of our portfolio on this particular setup, obviously in order to maximize our returns over the long run. Well, right off the bat, I hope many of you are having red flags pop up in your head. 40%? That's crazy! Isn't this module supposed to be about risk management? And you would be absolutely right in your assumption. Even though the formula says this is the optimal risk percentage, it just doesn't seem right, does it? I want you to hold that thought as I introduce one final concept that will help us develop an even more statistical approach to our trading. I want to bring in Pareto's principle, also known as the 80-20 rule. Now, many of you may or may not have heard of this rule, but its application will become very apparent as we move forward. Pareto's law states that 80% of effects come from 20% of causes. This stems back to Pareto's understanding that 80% of the land in Italy was owned by 20% of the rich at the time. This seemingly small observation has had perpetual effects on our society as a whole. But as it relates to trading, most of our trading setups will not have a drastic impact on our portfolio or equity curve. That is, that most of our trades will be throwaways, in the sense that we will earn normal returns that fall within one standard deviation, similarly to a bell curve. However, depending on the type of system you create, whether it be utilizing set and forget, partial take profits, trailing stops, or what have you, you'll come to realize that approximately 20% or less of your trades will end up turning into the big winners, the home runs, ones that will help push your equity curve higher and higher. These are the trades we like to let run after catching a great entry. You'll note that I added big losers as well, as newer traders have a strong tendency to get emotionally attached to their positions, and unfortunately sometimes they let them run far longer than they should have. This creates a very noticeably negative impact on their portfolios. That's why we strive to implement risk management from the get-go, to avoid the common but deadly mistakes most new traders make that lead to the 90% of traders who quit. Now let's see if we can implement Pareto's principle into our modified Kelly criterion. You'll remember that our previous example gave us a calculated risk of 40%. Now, knowing that 80% of our trades will be throwaways, what happens when we multiply this answer by the remaining 20%? We get an optimal risk of 8% as opposed to the original 40%. Well now, this seems way more manageable, right? By multiplying our modified Kelly output by 20%, we are accounting for the 80% of trades that will likely be throwaways. In essence, we're limiting our risk to 1/5 the original output. By doing so, we give our system more time to create profitable results. Lest we not forget that scary statistic that says losing streaks are inevitable. By implementing Pareto's principle into the modified Kelly criterion, I have found this formula to be the sweet spot as it relates to position sizing within my trading system. You, of course, are free to tweak this however you'd like. Implementing this does not guarantee returns, nor does it guarantee the holy grail of position sizing. However, by taking this statistics-based approach, we are one step closer to achieving profitability over the long run. Now, with all that said, I want to direct your attention to the topic of journaling. Now that we went through a multitude of math problems and theoretical examples using win rate, R multiples, Kelly criterion, and now Pareto's law, how do we even begin to implement these concepts as new traders? Well, the truth is that in order to use these concepts effectively, we'll need a much larger data set to draw our inferences from. This starts and ends with a journal. Journaling is the only way to improve our trading over the long run. By journaling, we start documenting our trades in a scientific manner that allows us to reflect on them at a later date. We can't start crafting a sound trading strategy until we start to figure out what works and what doesn't. Now, journaling can be as specific or as broad as you'd like. There are a few components that we suggest you document religiously. The rest are up to you. It is paramount that the trade setup parameters are documented. What is the expected risk-reward ratio of the trade? And what is the actual R multiple at the end? What is the entry, target, stop loss, and risk percentage? I always like to add a screenshot of the chart setup so that I can look back at a later date and remind myself why I took a particular trade. Now, how much or how little you add after that is up to you entirely. I like to document my emotions, hours of sleep, and hunger levels. By doing so, you'll start to build a clear picture of what ties your winners together and what mistakes your losers have in common. Did you sleep well enough the night before? Are you rushing into trades that end up being losers? Are your stop losses actually ideal entries? These are all important questions to ask yourself as you start your trading journey. Now, with all that said, let's circle back and recap what we learned. The Kelly criterion is a scientific approach to maximizing our portfolio as it relates to position sizing our trades effectively. Without a modified approach, we can't account for the varying R multiples different trade setups provide us. And depending on the inputs, the modified output may give us percentages that seem extreme at times. It is only through the addition of the 80-20 rule that we're able to safely capture the strength behind the formula. And lastly, Journaling is an activity that can only help improve your trading. In fact, without it, we stand to lose much more than we could ever gain by ignoring it. Journaling is the best way to keep ourselves accountable, identify our strengths, and highlight our weaknesses. Without journaling, we will never be able to implement a framework for risk management as well as profit optimization. Thanks again for watching, and I'll see you soon in the next course.